Uncertainty has been the main theme over the last quarter. Shifting Brexit deadlines throughout the year has meant that the economy has been in a stop-start mode. GDP grew by 0.3% in Q3 2019, having contracted by 0.2% in the previous quarter. This meant that the UK narrowly avoided a technical recession in Q3. However, annual economic growth is almost at a 10-year low of just 1%, so the recent figures aren't particularly worth celebrating. In the 3 months to September 2019, both the services and construction sectors contributed positively to GDP growth. Construction saw the highest 3-month growth of all the sectors, growing by 0.6% over the period. Services also grew at a slower rate of 0.4%. Growth in manufacturing and production, however, were flat over the period. Although Q3 transpired to be a relatively steady quarter, uncertainty, both domestic and global, is likely to linger on for the rest of 2019. Even if the current Brexit withdrawal deal gets Parliament's approval, negotiations over the UK's longer-term relationship with the EU could produce another cliff edge once the transition period ends at the end of 2020. In its autumn forecast, the Ernst & Young Item Club said that the UK economy is performing in line with expectations this year. As a result, the club maintained its GDP growth projection at 1.3%. However, the club, on the assumption that the UK will leave the EU at the end of January, cut its 2020 forecast from 1.5% to 1%, noting that the outlook for business investment growth had turned bleaker for the immediate future. Stockpiling activity was limited in the third quarter. Instead, economic growth was strengthened by increased household consumption and a bounce in UK exports. However, the CBI reported record stockpiling volumes in October, which will help to bolster Q4 economic growth. Provided the UK avoids a no-deal Brexit, Chancellor Sajid Javid has said that he intends to relax the government's fiscal rules to allow for a big increase in public borrowing and long-term investment. These fiscal loosening measures will allow for an extra £22 billion of public sector net investment a year, with money targeted at major infrastructure projects such as roads and railways. The risk of no-deal Brexit has fallen in recent months, and many analysts believe that if there is a Conservative majority at the general election on the 12th of December, the pound will rise substantially, as it would imply a quick approval of the withdrawal agreement in Parliament.
The UK Construction Purchasing Managers Index rose to 44.2 in October 2019, up from 43.3 in the previous month, but remaining close to the 10-year low seen in June. October's PMI survey revealed that the construction sector remained in a downturn, with building activity falling at the second fastest rate since April 2009. Respondents noted that new orders dropped steeply and that firms trimmed employment in response to lower demand, client hesitancy, and low confidence. Commercial, civil engineering, and residential activity all contracted in October. The marked slowdown was attributed to political uncertainty, but respondents were mildly optimistic that construction output would pick up over the next 12 months. However, the PMI, which can be excessively sensitive to firms' general concerns about political risks, has been consistently too downbeat relative to the official data. Accordingly, PMI readings tend to better reflect current business sentiment rather than act as a reliable guide to growth. After 3 consecutive quarters of decline, London construction output rose by 6.2% in Q2 2019. New work was the main driver of output growth, rising by 8.6%, whilst repair and maintenance work grew by 0.3%. The new housing sector was particularly buoyant, enjoying a 13% quarterly increase in Q2. New orders fared less well in Q2 according to the ONS. London residential new orders fell by 19% in the quarter, but remained slightly above the 5-year quarterly average. The build-to-rent sector, which accounted for 28% of all London construction starts in the first half of this year, is showing no signs of slowing down as developers and investors seek to meet the growing demands of tenants whose needs and expectations have evolved. London commercial new orders dropped off a cliff in Q2, falling by 49% compared to the previous quarter, to their lowest quarterly values since Q4 2013. Investment volumes in London's commercial office market have weakened in 2019 as some international investors watch from the sidelines, poised and ready to deploy capital if there is a favourable Brexit resolution. The All-Work UK Construction Material Price Index was up by 0.8% in September 2019 compared to the same month in the previous year. Material price inflation continued to soften over the summer, with prices reverting back to January 2019 levels in September. In fact, the price of all key construction materials in our graph fell in the 3 months to September 2019, with imported sawn or plain wood falling the most at -4.6%, followed by rebar, which fell by 2.5%. The cost of fabricated structural steel fell by 0.8% over the past 3 months as a result of lower demand. Although the outlook for global steel demand for the remainder of 2019 has weakened in recent months, steel prices are expected to moderate in 2020 due to ample supply and an anticipated fall in iron ore prices. The weaker material price growth corresponds with falling new order growth, suggesting that the softening of material prices is partly demand-led. Global economic weakness and slowing construction activity have also dented demand for materials, whilst falling energy prices have reduced production costs for materials. However, if stockpiling activity picks up again in Q4, the recent decline in material prices may soften.
Meanwhile, sterling has strengthened since early August, which would have helped reduce some of the upward inflationary cost pressure for imported construction materials, such as electrical wires and imported sawn wood. With regard to trade packages, we continue to anticipate that M&E and facades will experience the greatest cost inflation rates over the next 12 months. This is largely a result of higher skilled labour costs for M&E and increased workloads creating supply pressure for facades. Finally, G&T continues to forecast London tender price inflation for 2019 and 2020 at 1%, rising to 1.5% in 2021 and in 2022. The principal inflationary drivers remain, but with softer underlying trends. The outcome of the general election will have a significant impact on project tendering and market conditions generally, meaning that our inflationary forecast from 2020 onwards could change in either direction over a relatively short period of time. If you would like to learn more about G&T's quarterly London market update or see our most recent tender price inflationary forecasts, please visit our GT Market Intelligence website.